would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Yesterday's intro was a 1 in a bazillion, folks. That's the first intro I've done to the show since I don't know when, where I didn't do the whole real tour thing. It suddenly dawned on me yesterday after I did my trying to shake the universe up, trying to get the karmic wheel to start grinding over my head. So far, so good. I'm happy to report. I'm not saying it was because I did a different intro to the show yesterday, but it was because I did a different intro to the show yesterday, I'm sure. So, there you go. Welcome to it, folks. It is Wednesday. We're halfway through the week. I hope whatever you have planned to accomplish this week, I hope you are well on your way, at least halfway there. If not, I hope you're ahead of the game, and you'll be done by Thursday. Today's a kind of a smaller tidbits show. We'll see how far we get. I have a few. I've kind of tried to stay with this idea that one concept or one thing we're talking about per show. And I've been pretty good at that. But there were a few littler stories that really weren't worth a whole show that I thought would be nice to sort of put together here. Now, as always, the best way to get in contact with me is through the website at therebelbroker.com. From there, you can click on the big red button at the top that says take the survey to support the show. By doing so, you're not just supporting the show, you're also putting yourself in a drawing for a $50 Amazon gift card. So far, we've given out $150. We'll be giving out another $50 in January. So just get in there, use the same email address both times you're asked, answer the handful of questions, and you are in. So good luck to all of you who have already participated and those who are about to. If you'd like to join the Rebel Underground, you can simply text the word Rebel Broker to the number 44222. That's text the word Rebel Broker to the number 44222. Follow the prompts after that, and you are in. I had a listener email me yesterday asking, where is the store? I've mentioned here on the show a few times that one great way to support the show is if you're shopping for real estate books or really anything else relating to Amazon. Not anything, obviously they don't let me put just everything on the Amazon store on my website. But if you're looking for various things relating to anything really that's real estate related or business related books or just books in general, you can start at the online store at my website at therebelbroker.com. And I had a listener email me and say, hey, Robert, I looked all over your site and I couldn't find it. So clearly I have hidden this thing somewhere that makes it tough to initially find. Just to let everyone know, when you come to the website, there's a menu that appears at the top. It's right below the big red button I talked about a minute ago. And there are several menu options. One is Real Estate Realities with the Rebel Broker is the one that will let you pull that down and you can look at a page that says About the Rebel Broker. Another one that lets other real estate agents in the country join the Rebel Network, which is a network of real estate agents that think along the lines that I do in terms of wanting to deliver more for what they do as far as being real estate agents. So you can go to that link and sign up to become a member of the network. The next menu item over is support the show. And under that is the Amazon store and the show sponsors and partners page. So that's where I've hidden the Amazon store is under support the show. And then, of course, the next one is past shows, where you can go to just a page of just all the past shows. And then there is a menu pull down for you to subscribe to the show. And when you do that, it'll pull down and give you options to go to iTunes, iHeartRadio, Stitcher, Spreaker, or to just get the podcast only RSS feed. And then, of course, there is a menu item to email me. So feel free to take advantage of any of those options. I'll come up with a different way maybe to have that store. Maybe I'll just put the store at the top so that people can find it more easily. because that is a great way to support the show. It doesn't cost you anything. If it's something you're already going to do anyway, fantastic. If you'd like to just include the show as a beneficiary of things you're going to do anyway, I'm obviously forever in your debt for going to the trouble of doing that. So thank you for doing that. I'd also like to thank the folks who've been clicking the ad banner on the website. I put that thing on there just sort of as a lark, figuring we'll just see how it goes. And lots of folks are clicking on it. So thank you very much for supporting the advertisements that are appearing on that one spot on the website. Okay. With that out of the way, let's go ahead and jump in. Now, first thing I want to do is sort of reference back. We've talked a lot about things that I think are important touchstones, I guess you could say, or at least reference points. Maybe that's a better phrase. For things to be worried about moving down the road, things that could potentially reflect big concerns. And one of the things we talked about was the pension, the firefighters and law enforcement pension in Dallas, Texas. And it was a particularly interesting problem because Dallas, by all other measures, is a ridiculously successful city. Dallas is growing. Dallas is all the things that indicate more money is going into Dallas are on the rise, right? It's a city that almost is the poster child for success. And yet, despite that fact, they are faced with bankruptcy relating to their pension. And when we first talked about this, we were referring to Dallas as sort of a canary in the coal mine. Because if a city like Dallas can have this problem, this is not something that's going to be a one-off. This is not one of those things where 20 years from now, we're going to look back and go, wow, that was a weird thing that happened to Dallas. Now, Dallas did make some investments that exacerbated their situation in terms of making things worse for them. But they are not by any stretch of the imagination unique. And I also want to thank one of my listeners who enjoys the show on YouTube. That was another thing I did just because I could. And the last time I looked, there were something like over 50, 60 something folks who are now subscribing to the show through YouTube. And that's a relatively small number given how many folks enjoy the show each day. But considering how little time it's been on YouTube, that's actually pretty good. But I had someone who commented on the show relating to Dallas's problems. And he was trying to make the point that, this is the beginning of that trend, not the end of it. And I totally agree. And I wanted to make sure that I made that clear. I thought I made it clear in the show that we did. But this is something that I'm telling you specifically about Dallas with the suggestion that the problem here is the way many of these pensions are handled. They are the ultimate Ponzi scheme, right? Where, all those things that we always scoff at. With pyramid stuff, right? Whether you're talking about selling supplements or, as long as you recruit 6 more people, right? It's that kind of a thing because all the folks who have retired and are getting benefits are getting it based on what the people who are currently cops and firefighters or whatever governmental thing, whatever they're paying in. But then it also relies on the money being handled responsibly. Well, and this is a huge government thing. You're not going to find pensions so much in the private sector anymore. It's all in government agencies because really the rest of the universe has learned the lesson that these things are dangerous and they tend to ramp up to a point where they can kill you. And that leads us to our discussion of Dallas. Because you can't argue, Dallas isn't doing well. Dallas is suffering on a lot of levels in terms of lack of growth, lack of jobs. No, not at all. This is one of those situations where you can point specifically at the pension system and say, even in an environment where it would have the highest probability of dramatically succeeding, where a city would have tons that's successful in almost every other way, can be brought to its knees by a pension. And as we mentioned, it's just the tip of an iceberg that everyone needs to learn about because now there's an interesting story out that in addition to Dallas, now Fort Worth is in trouble. I find it interesting that both of these places are in Texas. Remember, these are both locations that have appeared repeatedly on areas that we should be looking at in terms of investment for a lot of different reasons. I think Fort Worth was on our return on investment list last year. In terms of people migrating, it was on our list this year. In terms of just general activity, desirability, all these various things, we've had this area pop up on almost every list that has approached the question of where are good places to invest. And if you've been a listener for a while, you know that we've covered that from a lot of different angles, whether it was places that are going to draw millennials the most, or places that offer certain activities of one kind or another the most. So we've covered these things from a lot of different angles, and these communities have popped up consistently as being great places to invest. So what's the deal? It is strictly this toxic pension program. And the worst of it is for folks who are in this, right? For the folks who were made a promise, who were promised by their unions and whoever else that this pension was going to be there for them. The things that they're doing, the actions that they're taking to protect themselves, which are absolutely rational, are just exacerbating it. They're making it worse. So it's one of those things where this could snowball pretty amazingly. But here's one thing that's interesting about what's going on with Fort Worth. And this, again, comes down to bad things that happen when these things get managed in the ways that they've been managed. The city plan currently has more net liabilities than assets. The pension liability for the city plan for fiscal year ending September 2015 jumped to $2.124 billion. The plan has more net liabilities than assets. Let's see here. The plan assumes 8% returns plus an extra 2% COLA in some areas. Projected salary increases are a modest 3.5 to 18%. The plan uses 5-year smoothed averages, which means that the Great Recession was already factored out. Quote, missing from the report are all the vacation hours the employees have stashed away. Some of the grandfathered ones have over 1,000 hours that will pad their benefits at retirement. It's safe to say this pension fund will never make it for numerous reasons. Benefit haircuts are coming. For some reason, Fort Worth escaped the scrutiny of Dallas. I suspect that will change soon. So, and this is not a gang up on Fort Worth. I think this is yet another call to everyone out there to look in their municipalities to see if these kinds of things are on the books. Any city that has pensions that are managed like this, which is very common in government, remember, and remember, the biggest job growth we saw over the last 7 to 8 years was in government. That's kind of creepy. You have to realize that there's a huge number of folks out in the population that rely on this and are planning on this. And the odds are that these folks are going to get trimmings put on their benefits. So it's going to be interesting to see how this plays out. Particularly, obviously, we're going to watch how these things play out in the Dallas-Fort Worth area. Do I suspect this will have a hit on the market? Well, it may mean that folks are forced to try to figure out a way to get more money that they can use for their retirement, which may equal selling a home that they currently live in to purchase something less expensive or move to an area that's less expensive. So it may see an increase in the number of properties being sold. It would definitely put the families that are going to rely on these under stress. And this is going to be true in any of these municipalities that are, again, using these pension plans. So keep an eye out for that. I think that in this particular market, everything else is so healthy. I think it could simply mean that we see a little bit of a blip in terms of properties that come on the market, in terms of folks that are in that retirement age transitioning from where they're currently living now to something less expensive. But just something interesting to note, and it's also going to be interesting to see what effect it might have in your area as this phenomenon moves across more and more cities that are going to hit this problem. Okay, what we're going to do next is take a look at what U.S. News and World Reports says we should be expecting for the year 2017 in the housing market. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We just did a quick recap of a subject we've covered before relating to pensions and some of the stresses that it could put on local marketplaces. We were specifically talking about Dallas and Fort Worth, but I don't want you to think, oh, wow, I'm glad I'm not in Dallas or Fort Worth. I think what I'm saying here is that a good thing for you to do would be to look and see what's going on in your local area relating to pensions. How healthy are they? Have they made any investments that have sort of pushed things over the edge? In general, I think you're going to find that most areas have these kinds of deals. If they don't, good. I think that represents some stability for you. But if you do see these things coming down the pike, the only thing that would worry me, I mean, if we want to talk about long-term down the road stuff, you have to figure out, where does the city get the money to make up these differences? Do they just declare bankruptcy? I'm not sure I can anticipate the idea that Dallas would simply declare bankruptcy. But they got to figure out where they're going to get the money. And for my feelings on it, I think most of you would probably agree, they go to the folks in Dallas. So I don't know if that means issuing a bond to try and bail things out. They'd first have to get rid of the pension system and replace it with something else, which means they'd still have to have a way to support the folks who are currently in the pension system. But they'd have to figure out some way to come up with the cash to pay off the current obligations, which could mean taxes, which could mean property taxes. It seems like a very fertile location to go would be to put in some sort of they'll call it temporary, but no taxes for temporary. They'll put something in that might be a property-related tax that would go directly towards paying this off. So that could be a burden that might be shuffled off to folks who own property in those areas. But again, this is just me throwing guesses out there. But given the track record of what what politicians do when faced with these kind of challenges, we've lived through this enough to know that we, the taxpayers, end up being the ones who end up having to pay for their mistakes. So that would be something that would be interesting to keep in mind as you're moving forward with your investments. Okay, so now let's talk about what the good folks at U.S. News and World Reports tell us to expect for the year 2017. Now, the first thing on their list is interest rates. And they make an interesting point that I don't think we've actually explicitly made here. And that is that the reason why interest rates have gone up recently has been because of the election of Donald Trump. Trump was promoting an increase of billions of dollars in infrastructure spending. My understanding is the last article I read was it wasn't billions, it was 1.2 trillion in infrastructure spending, which is a ridiculously huge, gigantic number. But what this did was sort of push folks into thinking that investors recognize that this is going to drive up cost of goods and inflation, and that is what and lead to an increase in the bond market and mortgage rates. So they changed the interest rate, or that's what really affected the interest rate the most. Sorry about that. In 2017, Trump has promoted an overhaul of U.S. infrastructure, and with that, mortgage rates have begun climbing in anticipation of a rise in inflation. Now, remember what we've talked about relating to inflation. When inflation goes up, interest rates go up, right? Because if I'm loaning you money, let's say I'm loaning you money at 10% right now, and inflation, I need to have an amount I'm charging you for interest that first takes care of inflation. Because if I just loaned you $10 today and didn't charge you any interest and had you give me that $10 in a year, you're giving me less than $10 worth of buying power when you repay me. Right? If there's been inflation over the course of that year. Inflation is an invisible tax. It takes the money in your hand and makes it possible for that money to buy less over time. So if I have $1 in my pocket and today I can buy one soda with that dollar, if there's inflation a year later, that's going to cost me, say, $1.25. So without changing how much money I have in my hand, I've changed what I can get for that money, right? So that's what inflation is. So when you're someone who's thinking about lending money, you need to understand in your head, I need to have a rate of return on my investment that I'm loaning that not only overcomes inflation, but then also rewards me in some way for the use of my money because I've lost the utility. I can no longer use that money for something because you're using it to buy your house, right? So that's why interest rates go up. They go on to say that another interesting twist could come from what happens with the leadership of the Federal Reserve. Rumors have been swirling about whether Federal Reserve Board Chair Janet Yellen may resign once Trump enters office, or if the president-elect may even try to force her out. Should that happen, it could cause a negative ripple effect throughout the economy as long-term speculation would become foggy. That'd be an interesting thing to see. I know that at one point he talked about auditing the Federal Reserve, but I'm not so sure that's going to happen. Next on their list is home values. They point out that home values have continually risen since reaching a low point in December of 2011. Zillow reports that home values have increased 6.2% over the past year, with the national median home value at $191,200. This is still less than the April 2007 high of $196,000, but a slow and consistent increase in home value is in line with historic appreciation trends. Now, one interesting thing I noted, and I'd like you to do this, about every month I go onto Zillow just to see what it tells me my house will be worth over the coming year. Something very interesting happened this week. Instead of it telling me it was going to be worth, I think it was estimating 2% more in a year, it actually is projecting, as of Monday this week, that my house will be worth 0.5% or 0.5% less than it is now. I'd love to find out what numbers they're looking at that indicate that. So keep that in mind. See if that, and you can check this historically, right? I happen to check it fairly frequently, but if you haven't, you can still see what it is. Go up to Zillow, go under sell, and then there's an option to look at the Zestimate for your home. I'd suggest you go and offer any more details on your property that aren't already there, particularly if the square footage is off or the number of bedrooms and baths, that sort of thing. Go ahead and enter that data and then see what the Zestimate is. And you can look at a chart that'll plot out historically what the home has been worth according to their estimates. But I thought that was a very interesting change. I was trying to figure out what might have changed over the last month that might have seeped their way into their algorithm that's calculating this stuff, because I thought that was an interesting change to switch from being almost 2% higher over the coming year versus now being 0.5% lower over the coming year. According to their estimate, the coming year should finally see a return, to a historically normal growth rate in the real estate market. Beware of the historically normal growth rate. If part of their normal is the time period from 2001 to 2008, that's not normal. And that's one thing that kind of annoys me about these numbers that people push out, is what they're basically telling us is look for what you felt like the market was doing, as if you were standing on the deck of the Titanic just before it hit the iceberg. That's the feeling that they're looking for, because that's what we were doing. We were navigating way too fast and way too crazy in a marketplace. So this idea that we want to return to what a lot of these folks refer to as historically normal growth isn't actually healthy. It's the crazy stuff from the early 2000s that folks are talking about. The past 12 years have been a roller coaster of highs and lows, jump starts and slowdowns. Rising rates and low inventory will slow 2016's momentum, but will not stop it. Both Zillow and the National Association of Realtors predict home values to increase 3% in 2017, which is kind of on par with what I was seeing. Remember, I was seeing about a 2% estimation from Zillow, but remember, that changed. So what changed? I'm really hot to find out. I did some Googling to try to find out what it was, and I couldn't track it down, and there was nothing on Zillow that indicated to me that change made any kind of sense. Let's see. Of course, there's also uncertainty. Remember, we've talked about how uncertainty can affect a marketplace. That can absolutely push interest rates higher. When people are freaked out by something and there's a lot of uncertainty floating around, the reaction tends to be an increase in interest rates. So the first actions by the new presidency are going to be key. There's already a lot of folks out there that are talking about some pretty crazy stuff that may or may not happen. Pundits on both sides of the aisle, the extremes are being flung, right, of what's going to happen. So I think the very first actions that are taken are going to set a tone. And if that tone confirms some fears, you could see that introducing some concerns or at least some instability or uncertainty that has folks taking actions that tend to do things that result in increased interest rates. Okay. DoddFrank in 2017, their expectation for DoddFrank, according to these guys, is as follows. Leading up to Obama's first term in office, real estate was a hot topic during the campaigns. Real estate reform has taken a back seat leading up to Trump's election, but he's made it clear he aims to wipe out a lot of red tape. While many have suggested Trump will repeal Dodd-Frank, it's much more likely he'll aim to cut out the unnecessary fat while allowing the general principles of borrower protection and lender transparency to remain. Despite the arguments over the pros and cons of Dodd-Frank, the true benefit lies in its far-reaching measure for the past 6 years. This will give lawmakers empirical data to analyze should they decide any paring down is necessary. I think you will absolutely see, at the very least, a severe trimming of Dodd-Frank, which will probably actually loosen up the system enough so that things can start to proceed at least at a pace that we're familiar with from before. It doesn't mean there's less protections. It simply means that a lot of the stuff that really doesn't make a difference one way or the other is going to go away. And you can look up Dodd-Frank and you can analyze for yourself what you think works and what doesn't. There's plenty of pundits on both sides, but there are definitely bureaucratic loopholes, or not loopholes, but hoops that you have to jump through that make the process really go on longer than it needs to. 2017, in terms of housing starts, according to what these folks are saying, the National Association of Home Builders currently estimates it will have 1.242 million housing starts in 2017, continuing its upward trend over the past 5 years. While home prices are not expected to make any major jumps, they will continue their upward trend, continuing to cater to repeat buyers. So if we look back on what we've talked about here on this show as it relates to the National Association of Home Builders, there's been a lot of contradictory stuff. We've seen surveys that talk about their confidence, right? The confidence levels of home buyers. But then at the exact same time, they're telling everyone that our confidence is super high. They're not building anything. And we are still, and in terms of just number of houses being built, at a ridiculous low point. Go out there, Google any chart that charts new construction over years, and you'll see we're at a ridiculously low point right now. So the demand isn't so low that it warrants that. So it absolutely needs to get kicked into high gear. Hopefully we can start to see at least a little bit of a turnaround in 2017. And I'm hoping against hope that the numbers they're quoting here don't refer to apartment complexes. We need to build single family homes or housing unit, whether they're condos, townhomes, single family residentials, whatever, things that folks can buy and reasonably get into without having to come up with hundreds and hundreds and hundreds of thousands of dollars. The bottom line that they say for us here is that our national housing situation is the sum total of hundreds of thousands of individual real estate transactions spanning a vast spectrum of local real estate markets. It's important to follow national trends and stories as they have a trickle-down effect, but it is imperative you examine your specific situation and surrounding area to find the best opportunity. Here's what it boils down to. The loosening of lending standards, expanding new home starts, increased equity in home values, and historically low mortgage rates will continue to fuel the real estate market throughout 2017. We've also talked about how the lending standards that we've seen getting shifted are not necessarily something you should be comforted by, since a lot of them actually mirror a lot of the crazy junk that got us in trouble the first time. The expansion in housing starts, well, we'll have to see. I'm not so sure those housing starts are going to be the kind of housing starts we need. And increased equity is always good. Folks who currently own getting more equity in their homes, I think, is fantastic. I would just love to see a little bit more of a marketplace where folks have a broader choice of homes to purchase at various price ranges. All right, so that's all that the folks at U.S. News and World Reports have to say. Of course, I will absolutely be including a link to this article in today's show notes, and of course also the article for the Dallas and Fort Worth pension problem. And I'll also see if I can dig up a chart on the internet relating to housing starts that has me depressed a little bit. So you can take a look at it and see if you're depressed too. In fact, I'll probably also post it to Pinterest, so you'll have that going for you as well. All right, folks, I truly appreciate you spending your valuable time with me. I hope that in return, I'm able to give you some great things to think about, maybe some topics that pique your interest a little bit and make you want to go check them out for yourself. Thanks again for listening, everybody. I'll talk to y'all next time.